Hello, team. Want to do like a flyover on each of the programs that we have here on the real estate in general. So, making Credit Bank a one-stop shop, giving you opportunities to help clients out across the board. And, we talk about some of the stuff that we already have going, some good deals. And very general overall, we can do real estate, anything that's not someone's primary residence. Outside of that, so rental, residential, all commercial asset classes, and the full spectrum of lending, meaning the whole stack. So no matter the location, credit, is the property stabilized? Is it vacant, etc.? We can get them into the property, get them out and into a new, the permanent financing. So there's a continuum with each client, 2, 3 loans, maybe more. And sometimes, we collect a lot of, not all the time, we collect the information up front so we can look at their big picture to see everything that we can hang a hat on and look for other opportunities. For example, we have one with Mike G. They came in asking for the second position lien on a retail property for $500,000. They're now doing a $5.5 million 40 rental property portfolio loan. So that kind of covers diverse property lending. So the 100% financing for fix and flip, and we'll get updated information on the website. But that's pretty hot right now because most places require 10% down, at least 5, 10, or more. On the acquisition, 100% of the construction component or rehab component is always going to be 100% finance because the lender wants control over that. It's going to be a reimbursement disbursement schedule. But we can go up to 75% of the ARV on the 100% program. And that's if they have experience and a 700 plus credit score. If they don't have experience and they have the 700 score, they can go up to 70% of ARV and not have to, they just pay the closing costs. And they can go down to a 680 or 650 score and still get 65% of ARV.
Is there a minimum per door?
Yeah, it's typically 50,000 is the lowest, 50 or 75. So good question. There's also square footage minimums typically, like 500 square feet. So, you want to raise those flags if we see that it's a small square footage, why we ask those questions up front, and the price per door. So like in a portfolio, it's like, yeah, it's a $5.5 million deal, but if that was like 80 properties and they're all below 100, then it doesn't get real cost effective for them. And each individual unit has to meet that requirement. 100% finance, so that's for residential, like the fix and flip, the 100% program we're just talking about there. There are other programs, if they don't have the experience or the credit, if the economics are there in the deal, we can get it done for them. Even if they're like super tough, like Mr. Grant, we'll work through it. We probably worked through that one more than we should have, right. But trying to bring the value on that. And then rental property loans outside of the fix and flip. So residential rentals, this can long-term, so like 12-month or more lease. And then also short-term, your Airbnb, Verbos, a lot of those down in this area. You can do 20% down on a purchase on those and up to 75% cash out. And then the portfolio loans, they're pretty hot right now. Like I said, you have 5 or more properties, you put them all in one loan, also AKA blanket loan. So it keeps things more organized. You just have one loan, one payment, et cetera. Everything's escrowed, including the taxes, insurance, and sometimes CapEx, capital expenditures. So if they have repairs that need to come up, they want to pull that aside so to make sure those reserves are there. Up to 75% cash out on those. So what a lot of people are doing right now, real estate investors that have built up a portfolio, is doing the cash out, extracting the equity to put that into more acquisitions and to continue to grow their portfolio. And then if they're purchasing a portfolio, just 20% down. And there's all different score levels there. So depending on what loan to value, credit score, and the loan amount is all going to go into what they can actually get. Hard money loans, so that's a broad term. That's usually going to be, that's inclusive of bridge, et cetera, as it says there. And it's on all investment property types, residential investment, as well as commercial and all asset classes.
John, can you break down the definition of a hard money? Because what we'll see multiple times is people in real estate using interchangeable definitions of something, right? Can you break down the difference and what the real difference is between a hard money lender and a private money lender?
Yeah, so there's a lot of different definitions out there. I can give you mine. I mean, to me, they're one and the same. Private money is, it's not from an institution or bank, or it just could be an individual investor. And hard money just falls under because it's underwritten differently and has, harder terms, essentially. You're looking at higher rates, lower leverage. And it's rate and terms are a function of risk, I always say, because if it's higher risk because of the property's condition, its income or lack thereof, it's going to make a difference on what they can get. And it's going to be like an asset-based typically underwrite. And then, private money is a broad term as well. Hard money is private money, I guess I should say.
Yeah, I would say that. And private money is like me and Luigi. We put our own money out. We're not necessarily an institution, but we have, a box that we need to fit into. And as far as private money goes, we were at a conference last week, me and John, and we have a lot of friends raising funds. And they want to see, when you're raising money, there's one thing that'll kill you: bad underwriting and not enough deal flow. Because when you're taking money from investors, you have to understand you need to put that money to work. If you don't put that money to work, your investors aren't going to be happy, and you can't afford the payouts. So we have a lot of people raising money right now.
Yeah. And so, outside of individuals, there's non-bank private lenders. So they're either backed by, a hedge fund or, a collective of investors, and it's more structured from a private lending standpoint. But hard money lets us get a lot of tough stuff done. They can close quicker as well. So sometimes it's for opportunistic situations. Either they have a hard deadline, like the money's coming due, their loan's matured, they have some other expense and they need to get that equity, or it's an opportunistic situation where, they need to close, in a week or less, or they're going to lose the deal. And those are typically like situations that have fell out elsewhere. They were trying to get their financing elsewhere, and we come in and, save the day type situation. And that's one of the, front end loans. And then we'll have their exit. Part of the underwriting of a hard money or private loan or bridge loan is we need to know what their exit is. Are they going to sell the property, or are they going to refinance out? If they refinance out, we need to underwrite that essentially to make sure that's a viable plan for them. And then we get to take care of that loan for them as well. Construction loans, ground up construction. So building from the ground up. And this is, on residential, individual units. We can do builder spec homes, models, and residential developments. So there's also acquisition and development money along with the construction. So this would include the horizontal improvements, getting the land and property ready. And then once that's done, to go vertical with building the houses or building whatever the case might be. And this is inclusive of, there's private loans for that, conventional and SBA. And then commercial mortgages, again, broad term, but all property types. So commercial is the broad type. And then there's the way commercial lenders are that some of them specialize in specific asset classes. So we have multifamily, apartments, mixed use. So that's going to have residential and commercial aspect to it. And then retail, obviously, like your strip malls or individual triple net, freestanding. And then office are, they got to be strong right now. They're tougher. That asset class has been beat up a little bit lately. And we can do, funky stuff like marinas, golf courses. We even do church financing. So all that is available. If there's real estate involved, just, ask me and then, say yes or no, we can do it. And we were talking earlier too, Mike and I, just asking the difference between, when SBA is involved in real estate. So there's 7A, which can be with or without real estate. And then there's the 504, which requires real estate. 504s are a little bit even more of a bear to get through than 7As because they're structured differently. A 504 is 2 loans, so it's from the sponsoring bank and then also the CDC. So then you come up with a blended rate, but it's 25-year fixed rates on that. And the 7A is just a guaranteed loan.
So one thing to understand there is the SBA has a $5 million limit on 504s too, right?
Correct.
So if somebody wants to purchase a $10 million property, what winds up happening is another bank comes in and they do the $5 million, and they do the first position with the SBA, and they do a position after that. And what they'll do is they'll give them a blended interest rate, which is the real rate on the loan. We had a situation we were looking at that had the same exact thing.
Well, and you can go up to 10 million too. So the same bank, like some of the SBA 504 lenders will give you 5 million SBA and then 5 million conventional.
Right.
Yep.
So it's technically 2 loans. So if you ever get that question, that's how you can go about the SBA loan. Okay, great. I have a question for you. Let's say I have an investor group that has a property under contract. They don't have the full down payment right now. Can we do a bridge for the down payment until they refinance out?
Yeah, if we're pulling like from one of their other assets, we do that a lot.
Okay.
Which, yeah, again, why we like to look at everything.
Because I heard about maybe I'm not using gap funding. Is it gap funding? Is that what it's called?
Gap funding is its own separate funding. And that's harder to come. Say again?
Would be like mezzanine debt?
No, it's like you'll pay 20%, but it'll be 20%, but it'll be like for 3 months or 2 months. Stuff Mark talks about.
Yeah, it's like a bridge loan essentially.
Okay.
Or I mean, we could just do a cash out on one of their other properties. Like if they have the equity to turn it into the cash injection. Yeah, my wheels are turning. I had another thought now too. Lost it. Any other program specific questions?
So we're gonna get a list of the programs out to you guys, right? And then we're gonna every other week do we say? We'll do a 30-minute, 45-minute call.
Yeah.
After later on in the evening, so it doesn't affect anybody's schedule.
And we can dive in deeper on each individual one, or even do case studies.
There's a lot of moving parts in real estate.
The best way to learn just by using a case study.
Yeah.
A lot of moving parts.
So if a guy, let me just say, maybe an example would be good. Like a guy has a 580 credit score. You know, he has MCAs, but he also owns property, right? So it can't be his residence, but it could be a vacation home, right? It's like a second home is something that we could look at. So if somebody just owns their own primary residence, that's the only real estate they own a business that takes in revenue. We really can't look at that property. That's the only property that man owns, right? We can't really, is that what you said in the beginning? Right?
Yeah, so we can't lend because it's business purpose lending. It's different, laws and regs for consumer lending. What we would suggest, like we do often in those situations, they go get a home equity line of credit from their bank, or we can recommend a bank if they need that equity for part of the deal.
They could go to their own bank, and we recommend they get a home equity line of credit, right? That's one way of doing it. We won't facilitate that, but we recommend doing
Actually, it's if you establish like bank relationships, like we talked about before, they're good reciprocal referral relationships.
Right.
You establish at a couple, you know what I mean, and stuff that falls out, stuff that a local bank or regional bank won't approve, and it just falls out. A bad loan's a bad loan, but
Right.
stuff that's just not meeting their box or their box at that time is usually sweet spot for us to do.
So if a guy has a business, right, we come to the conclusion that he can't get an SBA, we can't get him an MCA, but he has a vacation home that's worth $1 million, and he's got $500,000 in it, similar to what we're dealing with one of the guys, right?
Yeah.
That $500,000 that he or that house isn't finished. So let's say somebody has a finished house, right?
Yeah.
A finished vacation house that is their second residence, and it's worth $1 million, and he has he owes $400,000 on it. He has $600,000 equity in that house. Is that somebody that we should try to like?
The only way we could do that is if they did rent it out sometimes.
If they rented it, they were taking.
So if they like Airbnb it every once in a while.
He's like, okay, I'll start doing that now. I've never done it before. Like, how long do they? Like, does it need to show up on their tax returns for a year?
No, because the way we underwrite, I mean, that's another thing to keep in mind, like with the rental loans and stuff like that. Like we don't need it's DSCR, debt service coverage ratio. So it's based on the income of the property.
Mm-hmm.
We can even do it without DSCR, but as long as it meets that intended use.
Okay, so if somebody was like, all right, yeah, I have $600,000 in my vacation home, my business, I need money right now, I need $100,000. I can't get it for the business, but I have $600,000 equity in my home. I've never rented out the home, but I wouldn't be against it. You know what? Nobody's in it right now. I'll put it on Airbnb, and they get somebody to rent it for a month, and he takes in $35,000. That 1 month of $35,000 income, is that enough?
Yeah, because he's changed the status, and then we have proof of it. So then we can run with it.
That's that 1 month.
There might be some gray area cases where, like, if he hasn't even rented it out or shown income from it yet, that we could do that.
Yeah, so how many months of rental income do you need to see on that?
So on the short-term rentals?
Well, if it's short-term or even long-term. Let's say
So the long-term, we're looking at the lease that's in place. So as long as there's still like at least 2 months left on the
they
lease.
have to show payments on that lease, right? So, for example, if I own a business and I lease that property out to my business,
Sometimes, depending on the program or product that they're into, sometimes they do ask for the proof of the rent receipt, and other times they don't.
yeah. So, I mean, essentially.
And that's where up front we place it in the rent.
So I've done that before. So I have a property in South Florida, but my business rents that property from me. And I pay out of my business account as rental. So this way there's income in that property, right?
Or two different businesses. So one business is paying another business.
Right.
So they'll just ask for like a copy of the lease, and then sometimes, like if it's a new signed lease, like proof of the deposit. We can do vacant as well, and then we'll just use market rents.
Bank statements though too, don't they?
They do, but that's more just to make sure you have the money to have reserves.
Well, a short-term rental won't have a lease. It might just be an Airbnb receipt. Right?
So if they own it already, then they'll ask for the history.
Okay.
on what it's brought in.
Mhm.
And keep in mind, the appraisal that's done on the investment properties has a part of the report that's going to get market rents as well. So not only the value, but what market rents are.
Okay. How about if somebody, in 2022, I used to rent out my lake house, but 2023 and 2024, I didn't. I have 700,000 equity in it. It's worth $1 million. Can I take some money out? I haven't rented it out in 2 years.
Possibly.
Yeah. Okay.
A lot of ifs, possibly. It
Yeah,
depends.
right. I know. I'm just thinking, these are the things that will come up on the phone,
And one thing to keep in mind, guys, is real estate deals are always going to go slower than traditional business financing, right? So, for your example, before, the numbers have to make sense in the real estate. How much equity is in it, right? How much equity they have right now, and for example, is the rent that they're getting covering the note, the new note, not the old note? Is it covering it? Because they want to know where the cash flow is coming from. Right.
And that's the debt service
the debt service. So,
calculation.
Right.
So you take the NOI, the net operating income, divided by the new proposed payment.
so if from a 30,000 foot view, if you own if I own 5 vacation homes and I'm independently wealthy and I never rent any of those 5 out, I just use them for my own use. All of a sudden I come up on hard time and I need money. I have 5 houses that are worth $2 million each. They're worth $10 million. I need a loan. Those 5 houses mean nothing to me. They are not going to help me at all.
They're really not going to fit in our box in most cases, right?
They need to be revenue producing.
You would want to refer them
You
to.
want to know how you're servicing the debt. If you
Right.
have no income, how are you paying me back?
You sell one.
That's what I mean.
So then you'd have to go with a conventional
The
mortgage.
appraisal is not worth like this. You and I had a convo about this, right? That appraisal that is worth $2 million is really worth squat, so to speak. as
No,
far
he's
as-
not saying that. He's saying that for it to be a commercial loan, it has to fall within John's
Oh, it's a
box.
commercial loan.
There's other loans for that, which would
Because when it
a
comes to
conventional
homes,
mortgage.
or second homes or vacation homes,
Right.
it's under the consumer protection laws and the New York State
Uh-huh.
mortgage laws. So, yeah.
Okay.
All
I got
the things you titled in.
not that it can't be done. It doesn't
It's
fit
just
in our
thinking
product.
of a way, wiggle around it. Yeah, there's ways. Okay, I'm just thinking.
There's other ways. Like I said, you can make that a reciprocal referral to a mortgage referral partner, like loan
Okay.
officer or a banker.
Okay, got it.
Like that's residential loan officers and bankers are great referral sources
All right, great. I know a lot of those. All right, it's good to know.
because they have a lot of opportunities like in their database and across their desk. Like anything commercial, just send it over to me, and then
It's in residential.
Yeah.
How, just as a rule of thumb, how reliable have you found all these public databases for valuation? Whether it's, oh my God, there's so many now.
Zillow.
Zillow, yeah, exactly.
So like when I'm looking at the residential investment property, I'll do an aggregate,
Yeah.
like Zillow, Trulia, Redfin, if the data's there, just to get an eye ballpark, right? And then if one's way off from the other, if they're all in like the same range, we know we've got a pretty reliable number. It depends on the area, right? So the more, if it's urban and suburban, you're going to usually have the market data. The more rural it gets.
The more rural, the less reliable.
Yeah.
Thank you.
But the app, we'll go over it. So I created a specific app it's called a quick app. It's Credit Banc branded. So you can fill it out over the phone with the client or send the link to them and they fill it out. And that gives us all the initial information. So it's not doc collection yet. It's if we can get to that next step. So trying to put things in place as we create, SOPs, et cetera, to streamline, make it easier for you guys to bring stuff in, make it easier for me to give you quicker answers and easier for the client to submit their information and us get through the process. And then they're already in the centralized system where if we go to the full app, the link goes back out to them along with the doc portal as well with the list of docs to upload. And it's all tracked and tied to each of you. You're in the drop downs. All right. Any other questions?
That's it. Thanks, John.
All right. Thank you.